You know, if S&P breaks the S&P 500 equity index into a growth portion and a value portion. And if you ask the definition of the growth stocks, they're the ones that are projected to have very high rates of growth in the future. But if you look at the value stocks, it's all about price. Low prices, low ratio of price to book and to revenues and to earnings. It's all about price, nothing about the companies. And what Andrew said to me, impressed on me, is that Buffett, the king of value investing, one of his important points is that when you invest, you should think of yourself as buying a piece of a company, not buying some piece of paper, you know, like a trading card, a piece of a company. And if you buy the stock of a great company and it stays great and its future stays bright, you should tend to want to hold it for a long time. Now, this is a great departure. And another thing he pointed out was, so what does a value investor do? You know, Buffett talks about having been able to buy dollars for 50 cents. What does that mean? It means you look in the gutter, you find what you think is $1, you buy it for 50 cents, it becomes worth $1, you sell it, and you look for another $1 that you can buy for 50 cents. So it's a constant rotating process of buying cheap assets and hoping they become fully priced and then moving on to another cheap asset. It's a short-term relationship, just designed to garner discounts. It has nothing to do with the long-run potential of the company when taken to extreme. Now, that's not really what Buffett has done in the last 50 years. But it's maybe, you know, he called it cigar butt investing. Maybe it is what he did, you know, prior to the 60s, but not since. And I think that Charlie Munger is broadly credited with getting Warren to stop doing cigar butt investing and start buying the stocks of great companies at good prices.